got some folks on early. We'll get started here at noon Central Time. So hang tight, grab a coffee, a water, something to drink, relax, and we'll be kicking off here in just a minute. Thanks. All right, we just hit the noon mark here, so I think we're good to get this kicked off. Super excited for the call today. First off, just want to welcome everyone. And again, thank you all for making the time. On behalf of your Baird financial advisor, I'm excited to welcome you to this month's Baird Wealth Strategies webinar. We're joined today by Mike Antonelli, PWM market strategist, and Ross Mayfield, investment strategy analyst at Baird. They're going to lead a really informative discussion day, really highlighting kind of what you need to know as you're looking at the investing landscape here in 2024. So I'll just briefly introduce both of these guys and hand over to them. For those of you unfamiliar with Mike, he graduated from Purdue University in 1995 with a degree in history and moved to Connecticut to work in the back office of AIG Trading. He moved to Chicago in 1997 to work in the back office of Dean Witter's futures division before moving to a 24-hour trading desk in 1999 to execute futures and options for FIMAT, if I said that right, Mike.
FIMAT, yeah.
A division of, is that Societe Generale? Is that correct?
Yeah, French bank, yeah.
Okay. And then he also got his MBA at the University of Chicago in 2007 before coming to Baird on the equity trading desk in March of 2007 as a sales trader assigned to the international team. This is where Mike began writing his daily email in 2010 as a way to let overseas clients know what happened while they slept. He started posting it online in 2013, and it is now known as the Bull and Baird blog. So if any of you are subscribed, you're familiar with that Bull and Baird blog that Mike writes. For those of you unfamiliar with Ross, he's an investment strategy analyst here at Baird, as mentioned. In this role, he authors investment research for advisors and clients focused on financial markets, the economy, and the benefits of long-term investing. He frequently appears in print, television, and online media to discuss markets and investing. Ross holds a bachelor's degree in finance from the University of Kentucky and earned his MBA from the University of Louisville. He is a former president and current treasurer of the CFA Society of Louisville. Before I turn the call over to them, just a few housekeeping items to highlight. For optimal viewing, we suggest setting your layout to the side-by-side view via the circle in the upper right-hand corner. All participants are in a listen-only mode, but we'd love to hear from you. We will host a Q&A session at the end of the call to address as many questions as time permits. You can submit a question by clicking the Q&A icon in the bottom right-hand corner of your screen. Please be sure to address your questions to all panelists. This presentation is being recorded and will be available along with the slide deck through your Baird financial advisor about a week following today's call. So with that, again, thank you for joining us today. I'll now turn the call over to you, Mike. The floor is yours.
Thanks so much for the intro, Ross. We're so excited to be here. Ross and I, we love getting to do live events. We don't often get to do them together. Often we're on our own. I'm out on the road. Ross is out on the road. We do team events. We do big client events, but we've never had a chance, I don't think, Ross, to do a live side-by-side webinar to start the year. We got 470 people in here. We're growing by the minute. Super hot. We have some great content available for everybody here today. So what we're going to do is we're going to talk a little bit about 3 different things. Okay. We're going to talk about the economy. We just have to kind of touch on the economy. We're not going to get too far into the weeds. We're going to touch on it a little bit just to get us all level set on what's happening. You know, what's inflation doing? What's going on with the world? What's going on with the economy? We're going to talk about the markets. Certainly you come here to hear a little bit about the markets. You guys want to know about investments and bonds and all the things that that make up our complex investing life. So we're going to talk about that real briefly. And then stay tuned. At the end, we're going to talk about elections. You ready for that? We're going to talk about elections. This is a year to remember, right? We're starting off 2024. Ross and I are super, super, I don't know if excited there is the right word. Maybe we're a little nervous to have to talk about elections, but we are going to touch at the end of that, at the end of this triple header here for you. So give us about 45 minutes. If you're watching this live, thank you so much for spending your noon hour with us. Maybe you got some lunch, you got something in front of you, a coffee or a drink or something. Kick back, relax, listen to us talk. If you're watching this recorded, thank you for taking some time to watch us recorded. We really do appreciate that. We all know your time is precious, so we will not waste it here. 2024, I'm going to say a couple things, and then I'm going to kick it over to just Ross for his kind of intro thoughts here. 2024 is going to be a super important year in your life. Super, super important. And certainly every year has its importance in your life, but I think 2024 is going to be crucial for you as an investor, crucial for you as a client of Baird, because this is going to be arguably the biggest opportunity for you to make a mistake. 2024 will be the biggest opportunity for you to make not just a mistake, but an unforced error, because you are going to be bombarded with information. You're going to be bombarded with election talk. You're going to be bombarded with headlines, some super scary. And 2024 will be a chance for that to break through to you and make you super nervous and potentially cause you to make a mistake. Ross and I, that guy over here, he might be over there on my screen, I don't know where he is. We are going to stand in the way of that. And so will your advisor, and so will Baird. We are going to stand in the way of that to help you get through this year. Ross, this is a big one, right?
Yeah, it is. I mean, fundamentally, I think investing is harder today than it's ever been. We've solved so many of the financial and quantitative, parts of this that, people in the 50s and 60s didn't know. We know how to build optimal portfolios. We have, mile deep research on individual companies, but we also have a 24-hour news cycle that, if you look at some of the research, increasingly leans negative, competing for eyeballs, competing for attention. And so there's just going to be, as you mentioned, this just absolute blizzard of, information, and usually negative information, and sometimes partisan information that's often going to sound scary. And those are where the big mistakes get made. It's not in, I had my portfolio tilted this way or my portfolio tilted this way. It's preventing the big mistakes that are getting out of the market at the wrong time. It would have been getting out of the market in March of 2020, being scared by COVID-19 and missing a huge rally to come. Maybe it was even getting out of the market this fall and missing one of the best couple month rallies. But you're totally right. It's a year where things could go totally fine, but there's opportunity for a lot of mistakes and a lot of noise. And so, our job here is to do our best to kind of guide folks through that. And we're figuring out as we go as well. I'm going to turn it back over to Mike to get off the call, but I would be remiss not to mention that Mike and I do a monthly video podcast called All That Matters. And maybe I'm stepping on your intro here, so I'll turn it back over to you.
No.
But we'll be talking about this stuff all year as well. So this call is kind of our live version of that, but monthly for the rest of the year, we'll be back with it's usually 10 to 15 minutes, a little shorter and more digestible, but same ideas. So Mike, I'll turn it over to you, and maybe we can get going here.
Yeah, you'll see on your slide here, you'll see on your screen here, All That Matters. We are featured in a YouTube video series on Baird's YouTube channel. We have had just smash success with it. People love it. It's light. Ross and I talked about inflation last year. We talked about rates. We talked about Taylor Swift. I mean, we talked about so many fun things last year, Ross. We got incredible views on this. Make sure you're getting you're getting in touch with your advisor about receiving this, you can get this directly to your inbox on an email list. You can go to our YouTube channel. It's just a fun way for Ross and I to bring complex finance to you in an understandable way, because that is the key to what Ross and I do here at Baird. We like to really make this content digestible, understandable. You know what's happening, and you can engage with your advisor in a super, super intelligent way and a real durable, robust way. So all that matters on YouTube, that's our show. And if you listened to us last year, if you listened to us, I think you would have had a good year. We were constantly reminding people how the economy was evolving and how the stock market was evolving. And if you were listening to us, as opposed to some headlines you'll see in a second, I think you would have been very, very happy with our content. So please make sure you're watching it. This is going to be a live version of it, so you'll see a little bit about how we do. So, okay, first topic. We are going to kick off talking about the economy. The next slide is going to be a little word heavy. You don't necessarily have to read all the headlines, but we're going to put it up. I'm going to put it up here because I'm going to show you what you've been dealing with, what you've been bombarded with over the past few years. So this is a group of headlines. And Ross, I'm going to kick it to you after I set the stage here. This is a group of headlines that you would have read from major publications over the past year and a half. Bloomberg, CNBC, Yahoo Finance, all of these you would have seen at some point over the last year and a half. And all of them were telling you that a recession was coming, that bad times were coming. Forecast hits recession, it's 100%. It's almost impossible to find CEOs who aren't bracing for recessions. Jamie Dimon, who runs the biggest bank in the world, who has the most amount of financial intelligence any human being could possibly have, warned that the U.S. was about to tip into a recession in the next 6 to 9 months. And by the way, he said that in 2022. It didn't happen. These headlines are not signal for you. They are not. These headlines that you see, you might even see them today, they are not signal for you. Nobody knows how the economy will evolve because it's super complex. Ross, when you see these, how do you relay to our clients that this is really just, this is really just static?
Yeah, I mean, I think you said it right. It's just not a signal. It's financial media, and we participate in that to an extent, is informational. It's entertainment, but it's not signal. It's and obviously a few takeaways here. Like, this is hard. So like, these people,
Yes.
as you mentioned, Jamie Dimon is as smart as they come. He has more data at his fingertips from his huge bank than most people could hope to get, and he still obviously got it very wrong. And so these calls are really hard. They're really hard to get right once, much less a bunch of times in a row. And so for a long-term investor, the better strategy is to make sure you're on plan, make sure that you're on allocation, but not give in to what ultimately is noise. If you find it entertaining, if you like it, I'm not telling you not to watch it. I think everyone could probably watch a little bit less news, but the main thing is to separate out, what is entertainment, what is noise versus what is actually meaningful for your portfolio. The other thing I would say is, again, these are smart people and algorithms and whatever Bloomberg had going on there with theirs. The economy is very, very different post-COVID. There was a lot of weirdness that could not be accounted for in economic models. All the PhDs at the Fed got it wrong. This has been a very difficult economy. And, not to toot our own horn, because we'll get it wrong as much as we get it right too. But, all year last year, there were reasons to remain optimistic and to be, rational optimists about the world that we were living in. And it bore out. The market was up 25+%. A mixed portfolio was up big. We'll talk about the markets, but I think the big things are, one, these calls are really hard to get right, and they're really hard to get right a bunch of times in a row. And then two, we're dealing with an economy that doesn't fit into any models here. And I think that's shown up in how people's forecasts have gone.
And I just write, Ross and I, in our All That Matters series, basically said last year, we think things are mostly okay. We think things are getting better. That's what we said the whole year. Do you know where I and Ross did not appear? We did not appear in these headlines. We just did not. But we're talking to our clients about that, and that's more important to me than appearing in a headline. I know the same for Ross. You're just not going to see CNBC or Bloomberg put a headline out that says, strategist thinks things are mostly okay. The economy is going to bounce up and down, but thinks things are mostly okay. They will never write that. You will never read that, ever. You're going to read these headlines. In fact, there was a guy named Harry Dent, who's a prognosticator, who came out earlier this year and said 2024 is going to be the biggest crash of our lifetime, down 80%. And we had clients talk to our advisors who talk to us and say, what's the deal with this? He's just getting headlines because he's saying that. You're just never going to see Ross and I in the Wall Street Journal saying things are mostly okay and we think we should stick to your plan. You just won't. You're just going to see the people who say this year after year after year. So learn to filter this stuff out. Does the economy have its ups and downs? Yes. Does it fall into recession sometimes? Yes. Absolutely. Why is it not falling into a recession? We're going to kick into the next slide. And Ross, it's a little chart heavy. Tell us what we're looking at here.
Yeah, this is as wonky as we'll get in this presentation, I think. But it's important because these are the 6 main items that the National Bureau of Economic Research uses to make like the official US recession call. And if these things are doing well, they're not going to call a recession. All those forecasts for a recession in 2023 didn't come to bear. And why? Because these things were actually up. These are measured over the 6 months ending November 2023. And the big ones are here. So the first one, real personal income, less transfers. What are people taking home in income after inflation, real money, and not government spending, not government checks? So that's ex stimulus. That is just pure uncut wage growth. The next two, non-farm payroll, household survey employment. Do people have jobs? Are people getting jobs? Do people who want to work have the option to get a job? The next one, real spending. The consumer is 70% of our economy. If you break down GDP, we used to be a manufacturing economy. Now we're a consumer services economy. If our consumer is working and spending, things are pretty good. The next one gets at that as well. Wholesale and retail sales. Are people selling goods? Are people selling services? And then industrial production, which is down, not too much, but this has been an area, manufacturing and industrial production. It's not as big a part of our economy, but it's certainly more rate sensitive. So higher interest rates have weighed. But look, the summation is 5 of these 6 things are up. A couple of them are up a lot. The labor market has been strong and the consumer has been strong. So we're not in a recession. And it doesn't, to me, look like there's one on the near-term horizon. Before we jump, Mike, is there anything that stands out to you worth calling out that I didn't mention?
This is, like Ross said, a wonky slide. You don't need to really focus on the numbers and the charts. Or what essentially these 6 indicators are how's the economy doing? That's really, Ross had a really nice summation about each one. It's just how the indicators are, how's the economy doing? I just want to end on just you. I want to end on you and me and Ross and the consumer in general, okay? We are the engine of growth in the United States. Just we are. Do we have a job? What is our home price doing? Are we spending money? That's what drives the economy. Let me remind you that the U.S. consumer is probably, arguably, in the best shape it's been in decades. Now, 2 things can be true. The average U.S. consumer can be in a good spot where there are some people struggling. Those can both be true. I saw a stat. You see the stat all the time. I saw it this morning on Twitter. Somebody said $1 trillion in credit card debt, growing out of control. There's $1 trillion in credit card debt, which sounds like a lot, right? It sounds bad. It sounds like Americans are just borrowing and we're just over levered. Let me just give you a quick snapshot of the consumer finances in the United States of America. The United States consumers hold about $171 trillion in assets. $171 trillion in assets. That's homes and financial assets and land and financial assets, just assets, okay? Do you know how much debt, do you know how much liabilities the U.S. consumer in the United States holds? About 20 trillion. 171 in assets, 20 trillion in debt. Of that 20 trillion in debt, more than 2/3 of it is just mortgages. More than 2/3 of it is mortgage. So that 1 trillion in credit card debt represents the tiniest of fractions of our assets. Assets, my friends, are literally 8 times the liabilities of the average of the consumer in the United States of America. Don't fall prey to the nonsense. Don't fall prey to the nonsense that Americans are strapped. Are there some Americans that are strapped? Yes, of course there are. There are some Americans who struggle. Inflation doesn't help them. No doubt. But the reason why we stay out of recession is because we have jobs, we're spending money, and our home prices are very stable. Let's kick it over to the next slide, which is what I think everybody's angry about. Right? Everybody's just angry. They're angry about this. This is inflation in the United States. And it by the way, it dropped to 0.1% in May of 2020. We can take it back there. All we'd have to do is shut down the whole economy. We just have to have a global crisis, shut the whole economy down. We can get inflation down to 0. I don't think anybody wants that again. Then it surged to 9%. Why? Well, the long and short of it is that's the price we pay for what we did. That inflation is the price that we are paying for the stimulus and the breaking the supply chains and all that. That's the price we pay, but it has fallen, and it's down to about 3%, down from about 9%. And Ross, people are still mad, right? And I get it. Like, bacon's expensive, going out to dinner is expensive. I get it. I know why people are mad. It's 3%, but they don't care because things are more expensive, right?
Yeah, I mean, a few things. So one, you nailed it, right? So this is the rate of change is coming down. So the Fed targets 2%. It's down at like 3.5. But that's, even though that's coming back to where the Fed wants it, that's still 3.5% more expensive than it was last year. A lot of this is rents. So that's a big portion of people's budget. And it's really hard for people to, break into the kind of housing market or rent market and not feel that pain. People want prices to go back down. And the reality is that barring a global recession or a global financial crisis, prices are not going to return to pre-COVID levels in most parts of the economy. You might get, a nice TV for a good deal, or gasoline at times might fall back to $3.50. But primarily when inflation happens, there's a new kind of like level of prices that's set. Now, the good news is that by and large, wages have gone with this. Again, speaking in aggregate, the entire economy, some people have done better, some people have done worse. I completely hear that. In aggregate, wages have kept up with the inflation. And that's the big thing. It's not that prices are getting more expensive, but that wages are tracking along with it. And as of today, wage growth is actually a little bit ahead of overall inflation. But the other thing is, we're going to spend a lot of this year talking about, when is the Fed going to cut rates? When are we getting these rate cuts that everybody wants? Because mortgages are expensive, because credit card rates are expensive. And the Federal Reserve raised interest rates to combat inflation. They try to make things more expensive. People want to buy less, and it brings inflation in line. As inflation gets better, and it has gotten a lot better over the last 18 months, the Fed starts thinking about cutting rates. And so the big question is when and how many. I think all you really need to know is that the Fed will be cutting rates sometime this year, and peak interest rates are behind us. Would you agree with that, Mike? Is that too bold of a prognostication?
Yeah, I think we're probably behind the worst of the mortgage rates. I mean, mortgage rates hit near 8%. I think they're down near 7, maybe high 6s right now. So I do think with that peak in rates have happened. I just want to address what you can do. What you can do. You have to understand that what Ross said is true. Prices are not going to go back to where they were. Chipotle bowls are not going to go back to $8. They're just not. Newski's bacon is not going to go back to like $7. It's going to take time. That's what happened in the 70s. That's what happened in the late 40s. By the way, everybody was super mad at Truman. Super, super ticked off at Truman about high prices at the end of World War II. Time goes by and people get used to the new level of prices. That is how the world works. What can you do? You have to continue to invest, right? You have to continue to invest. You have to own stocks and assets and bonds and homes and to protect yourself against inflation. That's just holding cash is not the answer when inflation is rising. You need to actually invest and stay invested. I mean, there's no great way for me to assuage your anger about inflation. I hate it too. I can't stand inflation. And we haven't had to deal with these kind of levels in a while, but you just have to understand that the things are just not going to go back to the way they were, and we're just going to have to get used to the new level of inflation. Ross, we're kind of bogged down in the economy section. People are finding jobs, right?
Job market's good. Initial claims for unemployment insurance are still historically low. Wage growth is solid. People are coming off the sidelines. Marginalized people are coming back to work. Teens are coming back to work. It's a booming job market and defying all odds. So there's no point in belaboring just how strong our labor market has been over the last few years.
Yeah, if there's like if there's some, like, if you hear people say nobody wants to work, it's objectively not true. That's the most untrue statement that there is. Nobody wants to work is absolute garbage. Everybody wants to work. The unemployment rate in the United States is the lowest it's been since the 60s. If you were to think about where we have gaps in our labor force, you know what it actually was? Older workers. Older workers left the labor force post-COVID, and they really didn't come back in bulk. They retired. Maybe asset prices were high enough for them to retire, and that's where we kind of blew a hole in what used to be a pretty active segment of the labor market. But the job market's incredible. If I was a graduating senior in college, I think I'd feel pretty good about my prospects of finding a job. There's multiple openings still for every worker in the United States, and we could face that for a while with demographic changes and technology and AI and all those things. So I think that you need to understand that beside consumer spending, the jobs market is still very, very strong, and that keeps us out of a recession. That's one of the things that keeps us out. So all right, let's get to the market section. Everybody wants to talk about the markets. Maybe we kind of maybe give us a quick summary of last year, Ross, and then maybe tell us, what you see here. I love that you chose December 73 for the start date on this. I was born November 73, so $1,000 on my birthday would have turned into 205,000 by today. That's pretty cool.
Yeah, I mean, look, like ultimately, we are long-term investors. We're talking to people who we want to be long-term investors and participate in these kind of gains, right? We'll talk about what happened in 2023, maybe 2022, and maybe what we think of 2024. But the reality is, this is the Super Bowl right here. It's the long-term returns. It's the fact that a 20-year period has never been negative in the last century of the stock market. It's the fact that you can turn $1,000 into $205,000 over 50 years, despite multiple global recessions and wars and stagflation and bubbles bursting and COVID-19. And yet, stretch the chart out long enough and you see what it is. 2023 was just like a feather in the cap of this chart. 26% for the S&P 500, a mixed portfolio, which I think we have on the next slide, did very well. Bonds bounced back. It was kind of a tale of two markets last year. Early part of the year, it was a handful of mega cap growth stocks, and it was AI enthusiasm. And then the last 2 months of the year, it was the everything rally. It was small caps, it was financials, and beaten down sectors like materials and international rallying on the idea that rates had peaked and were coming down. So tale of two markets last year, but look, on December 31st, it says 26%, and that's a really strong year for the S&P 500, obviously. But only, it kind of slots right into this long-term idea that we talk about all the time.
Yeah, I just want to move on to the next one, because it's hard for strategists to talk about the market because there's so many different versions of the market. Okay, when we do these presentations, we have to say what happened, and oftentimes we default to just some large cap index or the Dow or something like that. But I want you to know that your results probably don't match the kind of stuff that you see in the news, right? You may not match the results of the S&P. You may not match the results of the Dow. It's because you have a diversified portfolio of bonds and stocks and international and small and mid and all those things. So the worst thing you can do is say, wow, the stock market was up this much last year. Why wasn't I? Well, that's just not the kind of index you'd be 100% invested in. Like there's really no great way for Ross and I to say, this is what happened in the market, this is what happened for you, because it will never match up. And I don't want you to think that, just because you see something in the news that should match what your portfolio does. This is a 60-40, which is a pretty standard kind of portfolio. 60-40s have done really well over the long run for investors. 60% stocks, 40% bonds. It's a pretty basic wealth management type portfolio. How did tough go over the past year and a half because of bonds? Like the bonds section of it really struggled with inflation. Bonds hate inflation. Bonds hate rising rates. But it had a nice bounce back last year. I'm just gonna give my 1 second take on why I think the market did so well last year, and maybe we can talk, Ross, about what we think this year. Markets trade on better or worse. I always say that. Over the long run, over the short run, are things getting better? Or are things getting worse? Are things staying the same? Those are really what the market asks itself every day. Over the long run, it's just the economy and the companies that make up the index, stuff like that. So 2023, things got better, right? They did not get worse. Inflation got better. The jobs market got better. Retail spending, it got better. So the stock market rewarded that. The stock market said things are getting better. And I'm starting to see the end of the rate hikes, and I'm starting to see the end of the peak rates. That's what the stock market said to itself last year. What about now? Well, we're still early. Ross and I are kind of struggling for things to write about. There's really nothing happening right now. We're kind of coasting on last year. Are things getting better, worse, or the same? I think they're still just the same. There's really no change in January 17th than there was in December of last year or November of last year. I think things are the same, which is why the stock market's kind of going nowhere. But Ross, why do you think the market did so good last year? Similar views, or?
Yeah, better or worse, and expectations, right? Expectations are everything. And as we talked about the first slide of the deck, on December 31st, 2022, expectations were for a recession. They were for corporate earnings to fall. And we didn't get a recession and corporate earnings didn't fall. And so the market has to reprice what it expects the future to be, what it sees in the world. And, I think, that was a huge part of it. It was just recalibrating that the economy was not falling off a cliff. You can't tell the story of 2023 without talking about the big tech stocks and the AI boom. I think they really provided, it wasn't just the concentration, but like there was kind of an animal spirit. It's like an excitement about a new thing that sometimes you just need to juice the economy and juice markets. And at a time when there really wasn't much, and especially coming out of the regional banking crisis and Silicon Valley Bank in March, this AI stuff really kind of gave it was like rocket fuel for the corporate sector. Everybody wants a piece. Everybody's investing. People are getting excited about building things as opposed to thinking about, what's wrong with the economy or what's bad about the world. So, maybe we're years away from all that stuff, like really hitting the ground and being impactful. But sometimes you just need a little bit of rocket fuel, a little bit of juice to get these companies excited and these people working at them excited. And that wasn't the only story, but I think you can't tell the story of 2023 without mentioning it.
Yeah, we're going to talk at the end about what we expect for how the market usually acts around elections. This is an election year. That is going to be what dominates kind of price action. It's going to be what kind of dominates the tone in the market. Ross, I think, came up with this great view that I really liked. I'm not stealing it from him. It's his. He basically thinks that, this is a year where we have a little bit less economic volatility, right? We're not talking as much about inflation and retail sales and all that kind of stuff, but we might have a little more market volatility, right? So less economic worries, more market worries. Why is that? Well, the obvious reason. Just the obvious reason. I think if you want to just wrap up this section before we move on to actually maybe not wrap the section. Let me just see if I can put it into perspective why the stock market might have more volatility and the economy might have less. Think about COVID as us breaking the world, right? Snapping the supply chains, stimulating the economy. Think about it as cracking a bullwhip. But there's this thing called bullwhip effects in the economy. You crack a bullwhip after you do that, and the economy has these big ups and downs of lots of supply, no supply, some more supply, less supply. You get these waves. And we're now 4 years past that. And I think those bullwhip waves are starting to minimize, right? Big bullwhip waves, then they're starting to go out. And we're just getting back to a quote unquote normal type world that's not dealing with the after effects of a pandemic. And I think the stock market recognizes that, which is why we should have a little bit less worries about the economy and a little more about the election. A popular question, before we kind of move on to the politics section, a popular question that we get is, should I buy stocks at all-time highs? Should I be selling my stocks at all-time highs? You may not know this, but multiple stock indices made new all-time highs. The Dow made a new all-time high. The Nasdaq, I believe the Nasdaq made a new all-time high. The S&P 500 is close, so we're close to an all-time high. Should you buy all-time highs, Ross? Should they? Yes or no?
I'm beating the drum on this at the beginning of the year, which is that you only get new all-time highs in bull markets. I guess I'll explain the chart first, which is to show over the last 50 years, if you'd invested on any day, the gray bars are your average return over 1, 3, and 5 years. If you'd invested only at all-time highs, there are over 850 of them, but out of 50 years, that's only a handful of days. Only at all-time highs, your returns would have been better over 1, 3, and 5-year periods. At all-time highs, right? So I think people think about, you hit an all-time high and you're approaching a cliff where the only place to go is down. And the opposite is the case, right? Strength begets strength. Momentum in markets is huge. Momentum is such a powerful force in markets and investing. And so buying into strength, not standing in front of a market that's, a speeding train car, is the move. And so I would encourage people, if there's cash on the sidelines, and we know that there is, this is a time to lean in, or at least at a minimum, to not be scared out of the market by an all-time high, because it's a bullish signpost and not a bearish one.
Yeah, there's this notion in stock markets about momentum. Momentum. It's a very, very technical term, but really just, are things going well? Will they keep going well? The thing you need to remember about all-time highs is, if you were to say, I'm not buying all-time highs, I'm afraid it's at the top of the chart, it just seems like they're not a good time to buy, you would sit out vast stretches of bull markets. Vast. You would mostly sit out most of the 80s and 90s. And you cannot sit out vast stretches of the bull market and reach your goals. You just cannot. In the United States, in the stock markets, in general, When times are good, they stay good. When times are bad, they either get worse or they start to stabilize, right? So at all-time highs, the stock market is saying things are going well. Does that mean they're going to constantly go well? No, absolutely not. If something happens that we can't see, like an attack, or if some sort of geopolitical event happens that we can't see, then that would be the market saying things are getting worse, and then it would start to sell off. But if we're just in kind of normal times and things are slowly getting better, all-time highs are not something to be afraid of. All-time highs are not something to be afraid of. Certainly, when we show stuff like this and when we talk about stuff like this, we have to say past performance is no guarantee of future results. It's just that's what we say. It's to remind people that just because something happened like that in the past doesn't mean it's going to happen like that in the future. And that's true. But this is the evidence. The evidence of history is that it's slightly better to buy all-time highs. You get slightly better outcomes because things are going well. You're in a bull market. That's why that's the case. But it's funny, Ross, you often hear from people, I don't want to buy when the stock market's going down. And then they say, I don't want to buy when the stock market's going up. It's just, you can easily talk yourself into not wanting to buy the stock market ever. You don't want to buy it when it's at the top or the bottom of the chart. You could easily talk yourself into that kind of stuff. It's just much better. And we'll show you at the end with a great study, why that's what the actual answer to all this is. So
yeah, I don't want to step on that because that's an awesome story for you to tell.
Yeah, it is a good story. All right, here we go. This is the part everyone's been waiting for. They're going to watch the two of us tap dance through a minefield. We're going to talk about politics in a client update. And this is going to be probably the bulk of what Ross and I talk about when we go on the road this year. I'm already starting to craft my deck when I go see our clients all over the country. Probably end up doing some blogs about this. But here's what I want to preface this with. Before I go on any further, I have a list of disclosures here. We are not going to weigh in on the social issues of elections. That's not our role here. It's not our role to weigh in on what an election means for the social fabric of our nation. Ross and I are here, and we care about your money and your investments because those are the things that help you reach your goals. Those are the reasons you've partnered with us here. Planning, investing, charitable giving, all those things that we do for you here. We are here to care and talk about how these intersect with your money. And we have lots of data on this. We have lots of data from history on this. So I'm going to start with the most obvious of all the charts. I love starting with this chart. I think it's exactly what people need to see as an election shows up, Ross. What is it telling us?
It tells us that the market is apolitical, that the long-term trend in the market is going to occur irrespective of who's in office, of whether it's a unified or a mixed government. The market to an extent cares about big policy changes, but it mostly cares about corporate earnings and what's going on outside of Washington, D.C. There are things that matter. But as you can see, every period except for one, and I'm going to chalk that up to bad luck of getting the great financial crisis, the second worst financial crisis in the last century. And still, the mid 2000s only down 20%. The market is apolitical. This could be a line chart with no colors on it, and it would tell the same story. But for those who are inclined to, let me think of the best way to say this. There are people who are really concerned when the other party is in power, and it does affect how people think about their money. It shouldn't, because it doesn't affect how the corporate operators who are trying to create profits that ultimately go to the people who own their stock, which is you, operate. They don't think about it, so you shouldn't think about it either. This is a great chart. I would hang this on my wall if I could.
Yeah. So I like this one for a lot of the reasons Ross said, but let me just tell a few stories in here. In the 70s and 80s, you'll see a red and then a blue and then a red. But inside of there is the creation of Apple computers. Inside there is the creation of Procter & Gamble and Walmart. Inside there's the creation of Costco and Starbucks. Inside these blue and red lines that you see here, which represent a presidency, are the creations of companies. And those companies are what drive the stock market, their profits, their products. Those companies weren't created because a red or blue person was in office. They weren't. They were created because an entrepreneur had an idea to grow a business. And that happens no matter who sits in the White House, and that happens no matter who sits in Congress. that is what you're investing in. You're not investing in who sits in the White House. You're investing in those companies like Starbucks and Costco and Walmart and Procter and Gamble, who all go to work every single day and create new products and create profits for their investors to benefit in. The stock market goes up over time because of them. The stock market does not go over time because of who sits in Washington, D.C. That's what we need to focus on. We need to focus on that fact. And I've done this for a while. I've done this for 20 plus years. Every single time there's an election, I end up with a conversation or an article. Somebody says, if this person wins, I want out of the stock market. And then each time it just ends up not working out like they thought. It happened with President Trump. It happened with President Biden. It happened with President Obama. It happened. You can just keep going back. There are multiple articles you'll be able to find where people say, if this person wins, you should run from the stock market. And then it just doesn't turn out to be the case. When President Biden was elected, the stock market had its biggest post-election gain since Eisenhower. You can't make blanket statements about a certain party winning and then saying that it would affect the stock market in XYZ fashion. It's just too complex of an entity. It's just too complex of an economy. It's too complex of a world. This chart is very, very important for you to focus on, that the growth of the stock market in the United States is due to the companies and the people that make it up. Now, there are times we hear, I love this one. There are times we hear like, oh, this person, when this person is in power, something bad happened, or the stock market had a tragic event because this person was in power. Every single president, back to Herbert Hoover, has had a double-digit decline in the stock market during their time as president. Every single one. You can see them on the screen here: blue, red, all the way back to July of 1932, which is the Great Depression. And if you'll see on the right, you'll see a double-digit decline for every single one of them. Was it their fault? No. So Bill Clinton was in office in August of 1998. The stock market fell about 20% because long-term capital imploded and there was an Asian devaluation currency crisis. Is that his fault? No. COVID wasn't Donald Trump's fault. Okay? There's so many things on here that you could point to. John F. Kennedy, you had the Cuban Missile Crisis. All of these presidents experienced declines in the stock market because history happens to them. When the world breaks, they just happen to be sitting there in the chair, right, Ross?
Yeah, exactly. I won't belabor the point because you said it better than I could, but September 2022, it's interest rates, it's inflation, it's not Joe Biden. It's what is happening to the economy and what is happening to companies. And very few times throughout history is it because of a policy that comes from up in Washington, D.C. that these things start or happen. Sometimes they can, help them spiral. The Great Depression in the early 30s in particular, there were some bad policy choices, but by and large, it's the economy. It's the Carvel quote. So, yeah, you said it better than I could. I think this is important to remember. There will be a big decline in the next 4 years.
Every president, all the presidents. By the way, there was a question quickly about the previous slide, Ross, that I'm just going to touch. It was what are this red and blues? It's just the president. This one is just the president. Was there a Democratic president or was there a Republican president? And yes, these charts will be available to everybody through your advisor for a week from now. So there's a chart we did.
Yeah. Oh, you're going to say exactly what?
No, you say it. No, you said it. No, we're on the same page here.
There's a chart that shows basically the 6 potential, unified under each one and then mixed in different ways. They're all positive. There's one that includes the great financial crisis. That is, I think, up like 5 or 6% annualized. The rest are up 11, 12, 13% annualized. So we can get you that chart if you reach out. But that involves Congress, and this is just focused on the president.
Yeah, oftentimes clients say, well, you just looked at the president. What about Congress? Strategas, our partner, who's awesome, just the best. They have a study that shows all Republican government, all Democratic government, Republican Senate, RD Senate, look at every combination. And how did the stock market do? And that, my friends, they're all positive. They're all roughly the same. They're all roughly the same. The stock market does not care about the makeup of Congress and the presidency. It just cares about the companies. It cares about what these companies are doing. What is the interest rate? What does the interest rate structure look like? Apple Computers is not going to stop making new products because of the makeup of Congress. They're just not. Okay, let's look at re-election years. Okay, let's look at re-election years. We are in a re-election year. Ross, how do re-election years tend to be?
Well, election years in general tend to be pretty good, about 11% on average. And then re-election years have been closer to 13 or 14% on average. So number one, you don't have to worry about election years in general. The market has had a few bad ones, but it's mostly been pretty down the middle. You're right around that 11% long-term return. Re-election years have been even better. And to your point about shouting out our partners at Strategas, their thesis about why that is presidents like to get reelected. And when you're the president, you have some powers and some levers to pull on to help stimulate the economy in an election year. Stocks tend to respond favorably to economic stimulus, fiscal stimulus. In this case, our partners at Strategas this morning put out a report talking about a potential tax bill that's being worked on that would expand the child tax credit, which is a form of fiscal stimulus, and I think roll back some or expand business expensing. It's something to that effect. Basically, a tax cut for businesses and a tax cut for consumers. Those are the kind of things that if you look throughout history, they're littered. They're not always big. They're not always the multi-trillion-dollar bills we saw, early in COVID, but little things that can juice the economy, help the consumer in re-election years. And, that's how you end up with a 13 or 14% average in re-election years going back to World War II.
Yeah, so this chart looks at every presidential election year going back to 1944. What it shows is that if a president has stood for re-election, and, it's still early in the year, if a president has stood for re-election, the stock market has always been positive since the end of World War II. When there's been an open election, okay, no president stood for re-election. That's 2008, that's 2000, and it's 1960. The stock market was down in those years. It was down. Does this mean it's guaranteed to be up this year? No. Remember, Ross and I are never guaranteeing you anything. This is just the evidence of history. And Ross told you why. Why does the stock market do well when a president stands for re-election? Because he starts to promise, he starts to want to stay in office, right? He wants to be there for another 4 years. And the stock market does like those notions. There's a question here that says, does this mean fiscal policy has no impact on the stock market? Fiscal policy definitely has an impact on the stock market. Definitely. We're not trying to imply that a president and its Congress and their Congress can't impact the economy. When the CARES Act happened under President Trump, that was probably the most important piece of legislation in 50 years because it saved our economy from a crisis. And the stock market ripped because we pumped trillions into the economy. That was also one of the reasons why we had inflation. But fiscal policy can have an impact, which is what the president who's standing for re-election will most likely try to turn those knobs. So it is an interesting stat that if a president has stood for re-election, that the stock market has not been down in that election year. Then we are in one of those right now. Currently President Biden is going to stand for re-election. That's the current information we have for today. So we'll see how the year plays out. But Ross, as the year plays out, it can be thorny in the start, right?
Yeah, this is kind of the rub, right? And this is always a rub. The volatility in the market is the price we pay for the long-term gains. Particularly true in election years. This is over a slightly different time frame, but basically goes to show that the first quarter of election years, presidential election years, tends to be a bit rocky. And particularly around that kind of Super Tuesday where, everybody's coalescing around their choices for president and the rhetoric is ramping up and it's getting more news attention. People are starting to get a little nervous. The average has been that the first quarter is a little weak and there's been volatility. And then, as Mike mentioned, the real gains are often concentrated at the very back part of the year. It's really difficult to time the ins and outs of these sort of things. But as far as just like setting expectations, which are so important for how we think about performance and how our portfolio is doing, I would expect, I won't speak for Mike, volatility to ramp up this year. It was very muted last year. So maybe this year is just a baseline. I would expect it to be higher. But certainly in a presidential election year, in that first quarter around Super Tuesday, things tend to get a little volatile. So that's just, it might not happen, but that's where my baseline is based on history.
Yeah. This is called seasonality, which is we just take every presidential election year and average them out. What does it look like? The first 3 months of the year are uncertain. Why? Because we just don't know the candidates yet. We don't know their policies. We don't know who's going to win. We don't know who's going to lose. Like the market will struggle with that. And look, the stock market's down about 1% to start the year. So seasonality is happening to us right now. It's going to take a while to get our arms around who the candidates are, what the policies are going to be, what are they projecting if they get elected. So expects the first few months of the year to be volatile. But this is where we're going to stand and stop you from making a mistake. If it is, just remember we told you that in this event. If the first few months are volatile, be like, oh yeah, Those guys told me that's just how the market works in the first part of an election year. So just remember that. We're getting long here, long in the tooth here, Ross. Let's run through this one quickly. We've mentioned the economy matters. It really does. If there has not been a recession within 2 years of an election, the president, the incumbent, has been reelected every time. If there's not been a recession within 2 years of an incumbent running, that incumbent has won every time. If there was a recession, the incumbent lost. That's President Trump, H.W. Bush, Carter, Ford, Hoover, Taft. They all lost. So the election matters. This is also courtesy of our friends at Strategas. And Ross, it makes sense, right?
Yeah, it's Carl against the economy's stupid. So, the economy matters a lot. Incumbents have a real incentive to prevent a recession in an election year or the year before. And again, that has a big impact on markets. So just something to keep an eye out for. But again, at a bare minimum, for someone who might have been incentivized or inclined to think about getting out of the market to avoid the volatility of this year, these years tend to be pretty strong throughout history.
Yeah, it's just the economy is important. People care about jobs and spending and all that stuff. And does this mean that President Biden was guaranteed re-election? No, of course it doesn't. No, we're not saying any of this. Is just what's happened in history to kind of guide our thought process to helping clients through difficult moments. It doesn't mean anything. The world is a real weird place. I think that's the main lesson of the last 4 or 5 years, is that the world's a crazy place, and things that shouldn't happen all the time. So that's what the evidence of history is, because people care about the economy. The incumbent's going to have to deal with high inflation and people's unhappiness over that. That's going to be the case. That will be one of the main talking points as this goes along. So just to wrap this section up, then we just go to a quick time, like a quick timing section that we loved. Or should we skip? We'll do it really quickly. The election is going to be uncertain. Expect the first part of the year to be kind of crazy. Data would say that this election years are good years. That's what the data says. Again, we're trying to prevent you from making a mistake due to your view of whoever the party you don't want to win is. We're not here to weigh in on the social issues of that. We're here to protect you and grow your money. We are going to do that with your advisor the whole year. If you get upset, if something really, really bothers you, reach out to us. We'll do calls with you. We will have conversations. We'll get together as a team and really, really help guide you through this kind of stuff. So it's really, really important that you focus this year on trying to avoid the headlines that are going to say this is the worst election in history. You're going to see those headlines. Just make sure you take them slowly and with our help, please. Ross and I found this great study on market timing. Everybody wants to try to market time. Should I buy that? Should I buy and sell? Should I get out at the start of the year? Should I buy the low? Should I sell the high? Charles Schwab had this really, 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 really fantastic study that we're going to kind of borrow here just to kind of show you what it means. Ross, I'm going to set the stage. You talk to us about the results. Here's what they did. They took a 20-year period. Okay, a 20-year period, 2002 to 2022. That's 20 years. They looked at 5 different investors and they said each person's going to get $2,000 at the start of the year. Okay, so 20 years, everybody gets $2,000 at the start of every single calendar year. Peter, the first guy, is going to buy the low every year. He's a genius. He's a god. Ashley is super busy. She's just going to buy the first day of the year. She says, you know what? My $2,000 is going at the first day of the year. Matthew, he likes to just spread out his money. He's going to buy every month. He's going to divide $2,000 by 12 and buy every month. Rosie is just terribly unlucky. She's going to buy the worst day every year. She's terribly unlucky. And Larry just hates the stock market because he's afraid of the national debt. He's afraid of the news, and he's just going to stay in cash. He's just going to be in T-bills and cash. He's not going to do anything. Ross, okay, 20 years, 5 different investors, a genius, somebody who's terribly unlucky, somebody who just says, I want to buy the first day, somebody who literally just says, buy it every month, and somebody's like, I'm scared of the stock market. Here is how they did. Tell us, what's the conclusion?
So the conclusion is that obviously buying the low every year gets you the best result. But Rosie, the unlucky investor, the investor who bought at the worst moment every year for 20 straight years, ended that period with over 80% of the geniuses total. You turn
That's crazy. That's crazy.
I mean, that's unbelievable. It kind of goes back to the buying at all-time highs thing, right? Like in theory, that's the worst time to buy because you're right at the top. But over longer periods, the time in the market is what matters. Being invested, just getting that money to work, no matter how you do it, is so much more important than being the genius timer if you have the capability of that, which no one really does.
No one. I mean, Ashley, who buys the first day of them every year, almost has the geniuses total.
Yeah, exactly. It's just get the money in, get it to work, let it, compound as the market has done over the last century plus. And then the other big takeaway is that the only loser in all of it is Larry. Now, Larry has a decent outcome, but he's massively trailing the other four because cash does not keep up with the stock market because it barely has kept up with inflation over the last 100 years. And I think it's really important because we've seen this year over $1 trillion flow into money market funds, which are basically cash products. People, because you can get a 4 or 5% yield, people have been just pushing money into cash. We've seen it through all the data. And at the same time, this is the reality of investing in the stock market. You might be able to get 4 or 5% on cash, but it's an opportunity cost of being in the stock market over the long term, or even in a balanced portfolio over the long term, has done quite a bit better. So I think it's a really powerful study about what time in the market means, how important it is to accomplishing long-term goals, how important it is to beating inflation over the long term. Mike, do you have any closing thoughts? Maybe we can get to a few questions. I know we run long.
I'm just going to amplify what Ross said at the start of this. The math on investing, okay, the science of investing, the math, the books, the accounting, all the technical stuff, it's basically solved. It's mostly solved. We've spent 100 years studying all the data you could possibly study. It's mostly solved. The success and failure comes from behavior. Just full stop. Your success and failure comes from behavior. How do you act when times are very crazy? Do you just consistently stick with your plan? Do you listen to the plan that's put together for you, even in difficult times? Behavior is really what matters. This market timing thing's crazy because they looked at 78 total 20-year periods, 78 others. And in 68 of them, the results were identical. In 68 of the 78 other 20-year periods. And in the other 10, the person who invests in the first day of every year never came in worse than fourth. So the math is mostly solved on this stuff. It really, really comes down to how you act when things start to feel crazy. Can you stick to your plan? That's why you come to these things. That's why you partner with us. We're here to help you do that. And these studies all just reinforce the same thing. All the data is basically just gets reinforced constantly. So let's do a couple questions. It's 12:55. Ross, there's a couple here that I think we can blitz through pretty quickly. What do you think the outlook is for individual and corporate tax rates over the next few years? The Trump tax cuts are set to expire in 2025, so that will be part of the election. Both candidates will be talking about the Trump tax cuts for sure. We have an expert, Tim Steff, and I think it's better suited for him to talk about these things. It's probably still too early to kind of talk about the individual and corporate tax rates over the next few years. We just don't know what the candidates have on that view. Anything to add there, Ross?
Nope. I think you covered it. It's a 2025 issue.
Yeah, there's just not enough information to make an actual assumption on that because even if President Biden wins re-election, he might run on extending them. We just don't know, right? We just don't know what's going to happen with those. So this is where your relationship with us really, really also matters. Planning, right? Planning. We are going to be able to run scenario analysis for you if the tax cuts expire, if they don't expire. Great questions for your advisor. Run me some scenarios with taxes going up and down. There's another one with all the uncertainty with world events. Will all of the uncertainty with world events cause a spiral in the market at some point, Ross?
So there's always the market is built on uncertainty, right? There are known knowns and unknown unknowns, or I butchered that, but you know what I mean. Yeah. I don't think there's been a period in world history where there hasn't been uncertainty or geopolitical issues throughout the world. I think there's a potential that we're seeing an uptick today, but the markets have compounded all the long-term charts we've shown. There have been just countless number of wars, geopolitical skirmishes, political uncertainty, elections at home and abroad. That is not new, and it's not really part of the calculus. It's just one of the things that gets baked into the market assumptions because there's never been a certain period in history, and there never will be. And so that kind of uncertainty is just part of the calculus, I think.
Yeah, there's no quiet moments. There's no moment in history that's quiet. I'm a history undergrad, and I never thought it would be all that important, but it's maybe the most important thing I ever studied. there's no moment in history where everything was great and the person who you wanted to be in power was in power, and there were no regional conflicts, and there was no, there was no job. The job market was great and wages were going straight up and all those things. There's just that it never exists in our history. We live in the present, right? We do. We just live in the present. If the world was completely certain, you would get no stock market returns. If everything was certain, the stock market would give you nothing, right, Ross?
Yeah, exactly. If we knew what it was going to return, then what would be the point? It would be a treasury bill. You would get, a couple percentage
You
points.
want uncertainty. The uncertainty is how you get paid in the stock market. That unease, that uncertainty, is really, really why stocks return what they do. If everything was certain, again, you're really not getting returns. Were we technically in a recession? Go ahead.
I would just also say really quickly, part of it is just we're being served all this uncertainty more. 24/7 media,
Yes.
Social media, Facebook feeds, like we're just being served it more. So it might feel like there's more, but it's always been this way.
There was a question really early: in what sectors are wages growing? I looked that up really quickly. The top 4 sectors for wage growth from 2019 to 2021 are business services, social science and humanities research, security and armed service, car services, office administrative services, employment services all saw 15-20% increases in wages. Retail was number 2, medical services was number 3, automotive retail and services was number 4, construction was number 5, home services was number 6. All of these with 15% plus wage increases. I don't know about wherever you are, Mr. or Mrs. Client, but to get hired at McDonald's now is like $20 an hour here. Chick-fil-A, same thing. Amazon's in the 20s. Wages are up dramatically across the board since COVID. If you were to look at real wage growth compared to inflation, it's actually outpacing inflation. So while consumers hate inflation, and they do justifiably, they are getting wage gains from that. I'm sure they don't want to give their wage gains back. If they want the prices to go lower, they don't want to give their wage gains back. So there are wage gains to be had along the way here. Maybe we do one more, Ross. It's 1:00.
Yeah, and I would just say as well, if we don't get to your question, we're not avoiding it. Please follow up with your advisor, and they'll put it in front of us.
Okay, there's a national debt question, which Ross and I get a lot. We're avoiding the big elephant in the room: federal debt, 34 trillion. This has to result in a crisis at some point in the near future. At the end of World War II, President Truman's advisors all pulled him into a room and said that with the levels of the national debt, the United States would have a second Great Depression. So that happened in 1946. I can get you that story if you'd like to read it. So they said the very same thing at the end of World War II. And by 1980, the debt to GDP was 50%. It had been cut in half. History just repeats itself. There was no national crisis back then. In fact, Ross and I found a great tweet that had headlines from like basically the 70s, 80s, and 90s all saying crushing debt load, crushing debt load, crushing debt load. And the United States experienced the greatest GDP gains in basically world history over the past 100 years. There's no answer to how much debt is too much. Nobody knows. There's no answer to that. But the national debt will never shrink. If it shrinks, that means the economy is shrinking. What we care about is how fast we spend. How much are we spending? How fast are we spending? Not basically nominal levels of debt, right, Ross?
Yeah, a couple of things. So one, you talked about it at the top with consumer. What are your assets versus your debt? I mean, the assets of this country are basically uncountable. But the number one would be the ability to tax the world's most productive economy and world's most productive consumer base. That's an asset on our books. The other thing is I always, we're investing in companies that ultimately are trying to sell a product or a service. How often does, the corporate executives at Apple get together and talk about how the national debt's going to affect their iPhone 16 rollout, or the executives at Exxon about, exploring a new drilling site. So it's not that it doesn't matter. It can have an impact on yields, and there might ultimately one day come a level where politicians say this is too much. But as far as the near-term returns in the market, I don't think it's the big weight that it is occasionally made out to be. I don't want to dismiss it altogether, but I do think it's not the boogeyman that it's laid out to be sometimes.
And before I kick it back to Corbin, thanks for being with us. Remember, everything you read about, everything you see in the news, and your buddy tells you, or your friends tell you, you read in a blog, or somebody forwards to you, just ask yourself the following question: does the market know about this? Am I the only person on the planet that knows about this, or does the market know about this? If it does, it's been thinking about it. I guarantee you the stock market knows exactly what the national debt level is. I guarantee it does. Guarantee it. The things that truly, truly are a threat to your money come out of nowhere. COVID, 9/11, the GFC. Those are the things that the market has not been thinking about. The market is thinking about the national debt. Trust me. So Ross, I'm going to say thank you to everybody and then kick it over to you. Listen, we appreciate you being here. Check us out on All That Matters. We'd love to have you be with us and watch more of our content. We'll have something fun coming out for you next month. Ross, I had a bunch of fun doing this with you.
Yeah, I had a blast. Thanks for everybody for spending some time with us. Sorry we ran a little bit long, but we want to make sure we could get as many questions as possible. And, thank you for being a client. We appreciate it.
Just a couple of quick notes as we wrap up here. Already mentioned, but if this call was recorded today, it will be available in about a week following today's call through your Baird financial advisor, Baird contact, or on bairdwealth.com. So just keep that in mind. And then as you guys mentioned here, if we got a lot of questions in the Q&A chat. If we didn't get a chance to address it, please be sure to bring that back to your advisor, your Baird contact. We can loop in the appropriate resource. With that, Mike, Ross, thank you guys so much. Appreciate your expertise, insights here, and look forward to talking to you soon. Have a good one.
Thanks, bro. See ya.
Enjoy.